In this video we're looking at task 7 from the second sample assessment for personal tax. So this is about capital gains tax principles. So in part A we need to identify whether the following statements are true or false. So an uncle and niece would be treated as connected persons for the purposes of capital gains tax. So what do we mean by connected persons? So imagine that we have our person who's sold the asset, and so we're trying to identify who are the people connected with that person. So we would have perhaps our spouse or civil partner. So it's a person we're married to, that would be a connected person. So any of our relatives would be connected people as well. So if we have any of our ancestors, so our mother and father, and any of our descendants, any of our children, plus any of our siblings, so any of our brothers and sisters, but also any of their spouses and civil partners as well. So if any of them have got married or in a civil partnership, they are also connected people with us. Now also for our spouse, any of their relatives, so any of the mothers, fathers, grandparents of our spouse, and any of their children, and any of their siblings, plus any of their spouses. And then another possible connected person would be if we have a business partner. So if we're working in business with somebody, so we have them plus any of their spouses and their relatives. So in this question it's asking about an uncle and a niece. So let's imagine that our taxpayer is the uncle. So do we have any nieces that are connected? So the niece is the daughter of a sibling. Well, our siblings are connected people and their spouses are connected people, but not their children. So that means that an uncle and niece are not connected. So the answer is false. Second statement, a disposal of an asset caused by the death of a taxpayer is chargeable disposal for the purpose of capital gains tax. Well, that's false as well. Any asset disposed of because of a death would be part of their estate and would be dealt with inheritance tax. And then the gift of an asset to a friend would be a chargeable disposal for the purposes of capital gains tax. So the friend is not a connected person, it's not exempt, it's not a charity, so yes, that would be chargeable. Let's move on to the second part of the question. So Mr. A made a number of disposals of capital assets during the 24-25 tax year. So calculate the amount chargeable to capital gains tax if the asset was disposed of by Mr. A. So first of all, we have a car. So Mr. A sold a car for $12,700. He bought the car for $20,200. So how much capital gains tax is chargeable on that? Well, that would be 0 because cars are exempt from capital gains tax. Next, we have a painting. So Mr. A sold a painting for $10,400. He had bought the painting for $7,200, paying 2.5% auctioneer's fees on the cost. Mr. A had spent £400 in total insuring the painting over the period of ownership. So this painting is a chattel, so let's just revise what we need to do with chattels. So chattels are tangible, movable items, and generally they're relatively small, and therefore we have some special rules for them. Potentially they may be exempt, and this table helps to summarise this. So let's just remind ourselves what the rules are. So if we have a chattel that is low in value in terms of the proceeds, so we sell it for a small amount of money, but it also cost us a small amount of money as well, then these would be exempt from capital gains tax. So the government doesn't want to be taxing us when people are simply selling things on eBay or Marketplace. So just small items, yeah, let's not worry about them. And then if we look at the opposite end, if we sell them for a lot of money and they cost a lot of money, then this is a high value item, and therefore we're just going to treat it as normal and deal with the capital gains tax. Now, what if we have the situation where we sell it for a small amount of money, but it cost us a lot of money? So we're making a loss on this. Well, the government thinks, well, this doesn't really make sense. If you bought something for more than £6,000 and sell it for less than £6,000, why would you do that? So, it could be that we just were desperate for cash and we had to sell something quickly. So there may be a commercial reason why we do this, but it could also be that we're selling it to a friend and we're giving them a special deal. So what the government says, well, look, potentially you are reducing your capital gains tax just by selling something cheaply. So we're going to assume that the proceeds were actually £6,000. So yeah, you may still make a loss on this, but we're going to limit how much loss you make. And then the final situation is that we sell something for a lot of money, but it didn't cost us very much. So potentially we found a good bargain at a car boot sale, and then when we go to sell it, we discover actually it's really quite valuable and we make a lot of money on it. So the government doesn't want to penalise people for finding a good bargain at a car boot sale, so there's going to be a restriction on the gain. So there's the formula for working out the restriction. But it is a restriction. If the gain is small anyway, then we won't be restricting it at all. So in this case, we sold a painting for 10,400. So our sales proceeds exceed the 6,000, and we bought the painting for 7,200, which also exceeds the 6,000. So we're going to treat this painting as normal. But we're told that we paid 2.5% auctioneer's fees on the cost. And then Mr. A had spent 400 in total insuring the painting over the period of ownership. Well, that insurance has nothing to do with the capital item, so that insurance is a day-to-day expense, so that £400 would not be considered in our capital gains calculations. So to work out our gain, we'll take our proceeds of the 10,400, and then we need to deduct the cost, which was the 7,200. But remember, on top of that, we had to pay the auctioneer fees of 2.5%. So the 7,200 multiplied by the 2.5% gives a further 180 cost. So once we deduct the cost and the auctioneer fees from the proceeds, that gives us a capital gain of £3,020. Okay, next then, Mr. A sold a table for £6,720, and he had bought the table for £5,200. So we sold the table for £6,720, and we bought it for £5,200. So ignoring this restriction, let's work out our gain. So we have our proceeds of 6,720 and our cost of 5,200. So that gives us an unadjusted gain of 1,520. Now let's do the same calculation using the restriction. So it's going to be 5/3 multiplied by the gross proceeds of 6,720 minus 6,000, which equals 1,200. So in this case, the restricted amount is lower than the unrestricted amount, so we're going to have an answer of 1,200. Next then, some land. So Mr. A sold all of his land for £170,000. He bought 10 acres in 2005 for 45,000, paying 1,500 in legal fees. And because these are legal fees in relation to buying the land, that's part of the capital cost. He also bought 15 acres in 2010 for 65,000, paying 2,000 in legal fees. So 2 months before the sale, Mr. A paid 5,000 to a company to repair drainage around the outside of the whole land. So those relate to repairs, which is not a capital expense. That's part of our day-to-day expenses. So in this case then, all we need to do is take the proceeds and deduct all 4 of the costs, which gives us a total capital gain of 56,500. And finally, Mr. A sold a ring to his son for £8,000. Now this is a son, isn't it? So that's a connected person. And the rules with connected persons is that the government thinks that potentially because it's connected, it may not be a fair price. So we have to use the market value of the item when we sell it to a connected person. So it tells us that we sold it to the son for 8,000, but the market value on that date was 11,000. And that's the figure that we'll need to use for the proceeds when we calculate the capital gain. So the ring had cost Mr. A 6,750 to begin with. So our gain in this case is going to be the 11,000 minus the 6,750, which gives us 4,250.